My name is Cody Kraus, and I'm a real estate broker owner that's obsessed with everything real estate. Investing, building, selling, developing, farming, you name it. I've been doing this since I was 18 years old, and I've learned a ton through trial and error, and I've met some of the coolest people ever. This is a show where I invite these people on to talk about their experiences and mine, plus everything else real estate. Let's go. All right, well, welcome to another episode of the Everything Real Estate Show, and today I have two guests on my show, lucky enough to join me. I have Tyler Tiessen and I have Duncan Wilson. Guys, do you want to introduce yourselves to the audience?
Yeah, so my name's Tyler Tiessen. I'm a mortgage broker to the Windsor-Essex County area. I've been doing that for about 6 years now, and recently we started an administration company, and that has just developed into a mortgage investment corporation.
Cool.
Beautiful.
Thank you.
My name is Duncan Wilson. I'm a mortgage broker. We do service technically all of Ontario, but concentrated in Southern Ontario. I've been brokering for about 16 years, in the mortgage industry for 20 plus years. And yeah, we have run an administration company for approximately a year and a bit. And we've just incepted and started our beautiful MIC as of August.
Okay. And so for our audience, most of today's conversation is going to be about a MIC. A lot of people are aware of what the mortgage brokerage industry is, what you guys do. It's pretty straightforward. Maybe we can even set that aside for another day if you want to talk about that a little bit more. You mentioned mortgage administration. Doesn't sound like the most exciting topic, but maybe we'll touch on what that is, because all these three things coming together is kind of what allowed for the MIC and for all that kind of stuff too. So just so that we can educate the audience a little bit, we'll touch on that. But it sounds like you guys are mostly excited to talk about your MIC, which is a mortgage investment company.
Yep. Oh, yeah, 100%.
Okay,
yeah.
Cool. So you guys are through Dominion Lending.
Correct.
Right? Mortgage Suite is your mortgage brokerage. And you guys have obviously been doing that for a long time. You've been working with a ton of people around Windsor-Essex County and I would imagine further out into the province too. But that's your focus here. Now, what has spurred the start of a mortgage administration company, and what is a mortgage administration company?
Well, contrary to popular belief, mortgage administration is the most exciting and most incredible roller coaster of doing mortgages. But what spurred it, and I think Tyler's going to jump in and give some additives here, but the spurring of it was create a professional approach to the borrower for private lending.
Yep.
So I would say if you look into the early 90s, even the early 2000s, private mortgages were done, I'm going to say, out of the back of a shady looking house. You'd go to a guy and you'd ask him for private money.
Or a panel van.
Yeah, there you go. Yeah, or a panel van, yeah. And then there was payments. There has been lenders that I've seen in the past too, taking cash payments. It just was not an approach to the borrower. It wasn't safety for the borrower.
It wasn't professional.
It wasn't professional at all. And the borrowers obviously getting calls direct from the lender. I believe there was a lot of bullying going on, a lot of misinformation and control on the lender's side. What made us become an administrator was basically looking at this whole approach and saying, okay, something has to be a little bit different. Why does a borrower who's going to get a private mortgage have to bring in 12 post-dated checks? Like, come on. Do you carry a checkbook, Cody?
One of the few people that
geez, man,
just
bad example.
Totally got egg on my face on that question.
But no, typically nobody does because nobody accepts checks anyway.
Right.
I'm glad you brought your checkbook today, though. We're going to need you to invest in the MIC. But
An old soul.
The administration company the best way to phrase it is like a property management company for private mortgages.
Yeah.
Okay.
So we administer the mortgages. We're a one-stop shop to make it a lot easier for private lenders to privately lend.
Well, and heck, if I was a company that, like a lot of companies when they're first starting out, don't have a ton of money. They don't have the 2 years that the bank wants to see. They might need a private loan.
Right.
And so if I go to you guys and you're able to get me a mortgage, but you didn't have the administration company, how do I write off the interest if there was no formal reporting of, I guess, the amortization schedule, all that kind of stuff? So you guys would take care of that for the private lender on behalf of them and the borrower. So you act like the intermediary to make sure that everything's organized and above board?
Yeah. So we collect, we don't do post-dated checks, but
Thank
we'll
God.
get a void check from the borrowers, be able to pull the payments on the first of every month.
Direct deposit on behalh of the lender, like from the
so
borrower's
direct
accounts.
debit, direct deposit into their account. One of the, like, if we go back, I think the two main stories come out of this were a private lender had called and said, hey, where's this guy at with his mortgage payment? And I'm sitting there as a broker saying, okay, well, I gave you the loan. What do you mean? Well, he's 3 months late on his payment. And it kind of made me go, oh my God, like, why are you calling me now? We could have sorted this out.
Did you not put the checks in?
Yeah, did we not?
Did you leave them in your locker?
I have other stories about that. In regards to post-dated checks, where lenders, they don't cash those checks right away and then dump 3 checks in at the end of the month. Now, I'm not going to say all borrowers are irresponsible or anything. I'm going to say most borrowers think that their payments come out regularly. So they see what's in their account. They don't really go back and go, oh, my mortgage payment didn't come out. So then when that money gets dumped in, it NSFs and causes a whole train wreck of a situation where it's just a downhill battle against being in arrears.
And would your administration company report to credit bureau also? Like, is that
no, we do not report to the credit bureau. What we would do is we issue obviously the charge on title. We take care of those payments. And the coolest thing is we don't need the lender now to forget about missed payments. We see it on our end. So we know that we can help the borrower right away, because it is about helping this borrower, giving them a professional approach, but also creating a situation. I could go back another story where a private lender calls me up and says, my brother needs $100,000. And I said, okay, well, you have enough money. Why don't you lend him money? Well, I don't. Is there any way I can lend him the money?
Lend it through you, but
is there any way? Yeah. Is there any way I can lend him the money and he just doesn't know it's me? And this is like 5 years ago. I was like, no, there's no way of doing that. Well, now there is with administration. We're the ones who control the loan. So in essence, we're the ones who could be the big bad wolf and say,
so if
hey,
I look at my debit account, it shows
Investor Suite. Yeah. So in that case, they don't need to know who the lender is. So it's kind of anonymity for the actual lender themselves. They don't need to be known who it is. There's no conflict there either, because his money is being administered by us. We're actually the ones that control those funds.
Yeah. The bigger thing too with the administration side is a lot of private lenders, they're very high net worth individuals. A lot of the time they don't have time to go chase after payments.
Or check to see if they're actually getting inflows every month.
Exactly.
And you know what, when you have a third party intermediary between a borrower and a lender, it's just like in real estate, a big part of the value that we bring as realtors is sitting between the buyer and the seller and taking the emotion out of it. And so Dave Ramsey would love you guys for that, because he always says, never lend money to family, right? If you're going to give money to family, just give it as a gift or don't lend it, because Thanksgiving dinner doesn't taste the same when your brother owes you money.
Yeah.
Right?
Because then the brother could just be like, hey, it's not me. It's the administration company. I'm sorry. It's out of my hands,
Duncan,
brother.
Tyler, man.
Yeah, it's out of my hands.
They keep calling.
So that would be the one reason, the main aspect of it. And let's just be honest, it does give a level of control. So if we know and have more information on when the borrower is coming up for renewal, control that renewal, we can at least get them a better path to a better mortgage, which is the broker's side, which I don't want to go into too much today, but we can actually look at their renewals 60, 90 days ahead of time, knowing that information, and begin a plan to get them exited out of the private mortgage that we currently have them in under administration.
Saying often when you guys talk to us, you're like, yes, we can hook you up with B lenders and private lenders and high risk, high interest solutions for somebody who may not have the credit or the lending history.
Correct.
But our goal is to get them to a low interest product from an A lender in the future. And so with the administration company, if I'm not mistaken, I think you guys have told me before, now you can show a lender a 1 year, a 2 year, a 3 year track record of hit payments. And now we can take that and bring it to a lender. It can help make the case to transition the borrower to a more ideal form of borrowing.
Correct.
Yep.
I mean, not ideal as in 1.1 in 2020,
sure,
2021, but somewhere around a good rate, guys. Let's be honest.
Not 12.
Not 12.
16.
Not 12.
Yeah, cut that in half, maybe a little bit more than half.
All right. And so this is all, I guess, leading up to a MIC now. So you guys were originally mortgage brokers.
Yep.
Then mortgage administrators. And now you've started a MIC, and it's aimed, it's kind of, I guess, titled locally. It's named locally, but people from across the province, from across Canada can invest in it. Or why don't we start, what is a MIC? Because it's not a thing most people know about or talk about.
Yeah.
Tyler's probably going to add to this as well. So when we got the administration company, we can administer individual lenders. One of the best things you could do, though, is go to a mortgage investment corporation and say, listen, we have the means to administer your fund. And that's what an administration company can do. It can not just private individuals, but funds themselves. So I called around and I kind of got laughed at. Like, well, no, we already have an in-house administration. Why would we want you to administer? Mix from Toronto, Ottawa, all around the province of Ontario would turn around and say, no, we don't want you in Windsor administering our loans for us. We already have it.
We do it in-house. We'll save the money. Thanks. But
We
thanks.
do it in-house. So the best thing is, and I'm going to let Tyler finish this off, Tyler began to research. Go ahead.
So we looked at a lot of different vehicles where we could allow more people to invest in private mortgages. In order to properly diversify a portfolio of private mortgages, you would have to have millions of dollars. If you have a couple $1 million, $3 million, you can do a lot of residential mortgages, commercial, first, seconds, get a lot of different borrowers, and have a properly diversified portfolio of mortgages. So that way, if one or two are not performing, you'll still be okay to keep going. For the average person, you can't really do that. If you have $50,000 or $25,000 saved up and you want to do private lending, you can't really do that because there's not a lot of loans that small.
You put like a second on one specific property.
Yeah, and then you hope that guy's paying you.
And that's the biggest kicker there is like when you're doing individual private lending through the administration, it's putting your money in one stock. So that lender who may have only 500 grand, let's say he's only lending 500, he's putting all 500 on a $500,000 first mortgage. Now, suitability, not the best, because what if his stock doesn't return the return, meaning the borrower? What if the borrower just can't pay that mortgage?
What if the stock folds?
Yeah, there it is, right?
Expires.
So now he's going through his one investment that he's made. He's now going through power sale. He's now spending time and effort, or in theory, the administration company doing this, but it's all of his money in one basket. Whereas Tyler's saying you can diversify that basket. When you're in a MIC, it diversifies across all assets within the fund itself.
So there's a lot of good investing podcasts in Ontario, and a lot of them are like, never do private mortgages. And I get it, and I think it's for what you're describing is, yeah, if I'm giving Joe down the street a first on his house because he couldn't get one from a Schedule A bank, then yes, I'm putting all my, and if I'm mom and pop, okay, I paid off my house. I went and I got a home equity line of credit on it. And, maybe I can pull out 300 grand. That's what he needed. Well, I'm paying interest on that 300. I'm giving him all the money I have that I actually don't have because I borrowed it from my bank to give it to him. And now if he doesn't make his payment, I still got to make my payment to the bank that I took the home equity line of credit on. But my exposure is 100% on one property. So if I understand it right, a MIC allows you to do private lending with you're putting money out to the entire fund or to a section of the fund or however. But anyways, it's diversification, and you might not necessarily have to put in 300 to fund one property. Maybe you could put in 100. Or do you guys have a minimum?
Yep. So our minimum's 25,000.
Okay.
The way that the MIC works is you buy preferred shares of the corporation, and then that sits in a pool of money with every other investor that's in there, and then we lend that out across all the different properties. So your dollar is spread across every property that's within that one portfolio.
Yeah.
So instantly it's diversified across all those properties that we see fit based on our underwriting guidelines.
Now, underwriting guidelines and fund and I think after 51 shareholders, you have to be licensed to sell securities. So this would be considered a security that would then be, I guess,
exempt market security.
Exempt.
That's
Okay.
what it's called.
Want to expand on that?
An exempt market security.
Yeah.
Basically, it's regulated through the OSC and it's exempt from the market. Meaning, exempt market security is something that is not on the exchange. It has certain rules within an offer memorandum. So
it's private in the sense that the public can't go to a fund and buy it.
Correct. And there's no exit to those funds either. So,
but you still have the security of being provincially regulated by the Securities Exchange Commission.
I would say everything on this side's honestly regulated to the tilt. It's insane.
There's a lot.
So again, if I loan money to Joe down the street, I'm not going to be regulated by an exchange commission now, a Securities Exchange Commission. But if I'm going into a MIC, although I can't buy it on TSX, it's still going to benefit from the same, I guess, formal operational guidelines.
Yeah, it's going through the formal, still the same due diligence.
It's going to get audited regularly.
Yeah, I want to actually touch on the fact when you were talking about a guy who gets a home line of credit and then takes that money and lends it out to the other person. For our viewers today, That is the smallest and simplest definition of a collateral debt obligation. It's called a CDO.
Am I watching The Big Short right now?
Oh, buddy, there you go. That is actually your simplest form of collateral debt obligation. I borrowed against my own home to
At
lend you that
6%,
money.
to lend at 12%.
Yeah, that's a collateral debt obligation. We don't really advise it. There is some people that want to take that risk and obviously use their line of credit to lend out. Normally, and we've talked about this, do we want someone to go borrow?
I wasn't recommending it. However, I know that there are
No,
people.
no. I'm just saying. It was just funny to me. It stuck in my head because I'm like, that's a collateral debt obligation right there.
And we do have some of our largest investors that do that.
Yeah.
So that we do work with people that do that. We would recommend you have certain net worth requirements if you're going to look at doing something like that.
100%.
But
Do I have to be a qualified? Do I have to meet a qualification to be able to invest into your MIC?
Yep. So that's where I was going to go with the exempt market. So in order to invest in a company that is operating under exempt market regulations, with the OSC, there is certain requirements you have to fall under. So you have to either be an accredited investor, be friends, family, business associates of one of the directors of the MIC or employees of the MIC.
And accredited would be a baseline of net worth
Yep.
or annual income.
Yep. So annual income individually of $200,000 personal before taxes. If it's a spouse and a husband, then it's $300,000. If you have a liquid net worth of $1 million, any one of those will all qualify you.
Okay. I mean, it sounds attractive. Like a lot of households might have a $300,000 income, but they don't necessarily have $300,000 to give to a
net
person
worth.
on a private loan.
Right.
But they might be able to put $50,000 aside a year or every 2 years or something like that. And this would allow them to get exposure to the benefits of investing in private mortgages, but $25,000 or $50,000 increments at a time.
Right.
And then I guess my next question is, can you do that through a tax shelter like an
Yep.
RSP or a TFSA?
Yep. So we are approved with Olympia Trust. We are an investment that's allowed through RSPs, TFSAs, LIRAs, the registered accounts.
So let's say that I was a household that made $300,000, probably paying somewhere in the neighborhood of 51% income tax or 40% income tax federally and provincially combined.
We are in Canada.
Yeah, I love it. But I could dodge some of that, dodge the taxes on maybe 50,000 of that to bring down my average rate as a household, put that 50 into my RSP, and then get the benefit of the exposure to a collected pool of private mortgages through a MIC while dodging taxes on the way into it.
Correct.
Keep selling it. I like that, Cody. I like the way he's saying
There
that.
is other exemptions, though, that you can fall under. So friends, family, business associates, that's one exemption. The accredited investor is another one. One, oddly enough, is minimum investment through a corporation. So it's an entire exemption with the OSC. If you have a corporation that invests a minimum of $150,000 in a MIC or any exempt market, then that's a rule as well.
Does it matter if it's an active or passive corp?
It does not.
And
As
does
long
it
as it's a
matter where the
corporation.
ownership
Is
is
there
based
not
out of?
the minimum offering too, where you just read the?
There is. That's the next one I was getting to. So there's two others. They're eligible investor and ineligible investor.
Okay.
I can send you a cheat sheet for all of this, but eligible investor is if you make a household or an individual of $75,000 before taxes, or a household of $125,000. With that exemption, you can put in $30,000 a year as the maximum. There's
Okay.
limits on that one. Ineligible investor is you just read the offering memorandum, but you're capped out at $10,000 a year.
Okay, so
Even
you
though
don't
our
meet-
minimum's 25, it is confusing. But if you read the offer memorandum, you could put a max of 10,000 in there.
If you don't have any other requirements. So if
Yes.
you make
well, and that would
$50,000
probably
a
be
year,
up to you guys whether or not you actually want
Correct.
to take them at that
Right.
point,
Yeah.
right?
which we likely will. We have been able to waive the minimum for a few investors, but depending on everyone's scenario.
Sure. Okay. And so I think the next question that a lot of people that like this is a new concept to them is, okay, so I put 50 grand into my RSP, or I already had 50 grand in my RSP. Let's say that I wanted to sell some of the mutual funds that I had, and I'm going to go put it into Erie Shores,
Capital Mortgage Corporation.
Erie Shores Capital Mortgage
Your
Corporation.
Shores is good.
And okay, I put in my 50 grand. What does my return look like? Is it a percentaged annualized return based on the performance of the collective fund?
Yep.
Is it a dividend? Like, you want to dig into that
Yep.
a little bit?
So we offer it's 8.25% is our target rate of return. we're doing dividends monthly, and they
Okay.
compound monthly as well. So what every investor we have so
But
far is
8.25% is annualized, not.
correct.
Okay.
It's not 8.25 a month.
Come on,
Not yet.
take my money.
But if it is compounded, you end up around 8.57.
It does
roughly,
work
if
out
it's
to be higher.
Because you're
RSP.
compounding monthly instead of
correct.
semi-annually.
And we're
Correct.
relending
Yep.
that money out again on the dividend that came in. That's usually in regards to TFSAs, anything registered. Most of our investors so far have gone on the DRIP.
Dividend reinvestment.
Yeah, I was going to
program.
say, so I don't have to take the dividend.
Mm-hmm.
Like if I'm a retiree and I have most of my money in my account, and that's my monthly money that I get to spend now to live,
Yep.
I'll probably take the dividend in cash and pull it out of my account. But younger, still working family, younger household, you're going to want the opportunity to reinvest that dividend
Right.
most
let
of the
it
time.
grow.
Yeah, because you definitely want to capitalize on the compound interest, especially if you're at an early stage in your life. What that will do over years is
If you have an active income, I would think most of the time it's going to make sense to
Yes.
reinvest unless you had a different use for that money
Yep.
inside that tax shelter. Or you don't have to do it necessarily within the tax shelter. You could just give the funds to you guys, but obviously there's a benefit of doing it through an RSP or
Right.
TFSA.
Yeah, and then we can even go further and go into RIFs, retirement income fund, where the RSP has to flip into the RIF designation. At
The
that
Detroit
time,
radio station, right?
correct?
Yes.
The RIF, yes. It's
Dave and Chuck the Freak.
You should invest in that. But when it becomes a RIF, you have a minimum withdrawal amount. I believe that is around 4.5% now. So if you think about it, even in a RIF, once it gets flipped into that and you're in retirement, you'd want to look at your risk, things like that first. But you're withdrawing 4.5, but earning 8.25 on the annual. So it's actually growing as you withdraw from your RIF too. So it actually increases.
Because you're only
the
withdrawing
stream.
half of what your
Yeah,
targeted growth is.
yeah.
Yep.
Now, targeted growth sounds great, not a guaranteed
No.
by any means, right?
Yep.
And would you say it's a conservative target? Like, is there a chance it could outperform?
Yeah.
Yep. So right now we've been active for a few months now. Every month so far we've hit the 8.25%. We're tracking to maintain that for the end until the end of the year, and we do have a side bonus as well. So we do semi-annual bonuses with the MIC. So December and in June we bonus out if there's a surplus.
Okay.
The way that MICs work is it's 100% flow through. So all the money that's made in the MIC at the end of the day has to go to the investors.
On an annual basis.
After it covers administration fees, licensing.
Yep.
And all the work we're doing,
Yeah.
underwriting deals,
Yep.
working it. So
Now, does the fund cover one type of property profile? Like we only loan to single family owner occupants, or are we looking at multifamily, commercial, industrial, vacant land?
So in order to qualify as a MIC, no more than 50% of the portfolio can be commercial. So at least 50% of the entire balance has to be residential.
Any preference to owner occupant or landlord, like investor?
So our underwriting guidelines, we do prefer first mortgages for, if we can get them owner occupied, that'd be great. If it's a strong file for rental people, rental portfolio.
landlord.
Yep.
Yeah.
Landlords, then that's fine too. But right now, a lot of it is either first or seconds for.
and
Okay.
there's a difference between the regulatory rules and then what we created as rules as well. So there is mix out there, our commercial mix, things like that. And
But they're specifically set up and advertised
correct.
as such.
Yeah, we wanted to go after, and it would come down to not what the house is being really used for; it's the classification type. So we would do builds, we would do obviously owner occupieds and rentals. But as Tyler said, it has to make sense.
And there'd be different lending guidelines. Like if you guys are giving a second, it's not at the same rate that you're giving a first. And
Right.
like I know a lot of credit unions, sometimes banks too, will charge more on a landlord's investment property
Yep.
than they
Yep.
would on the owner occupant too. So I would imagine you guys are taking all that into account with their credit score.
Oh, yeah.
Everything else. And so like that's probably why you have your target return rate, but depending on the risk profile and the performance of the underlying borrowers,
Right.
that's where that could grow
Yeah.
or potentially
so
shrink.
we're returning 8.25. That's the benchmark, but we're probably in essence lending out around 10 and a half.
Okay.
Yep.
Right.
Because that allows for vacancy rates or periods where the money's not all lent out. We want to have the money lent out at all times so we can hit the 8.25 and give bonuses at the end of the year as well.
Okay. Now here's a loaded question, and I might be fairly ignorant
them.
in this scenario, but if I'm a bank, I can borrow from the Bank of Canada is it 90% against my deposits, something like that. And so like when we hear all these Bank of Canada overnight interest rate announcements, that's the rate, if I'm not mistaken, that the bank like TD or Scotia can borrow from Bank of Canada at. So are your interest rates changing as the Bank of Canada interest rate change? Because I guess that because you guys aren't borrowing money, you have money. You're lending the money that's in the fund. You're not saying, okay, we have $100,000 in our fund. Now we can borrow $900 from the Bank of Canada and then lend out at a rate based off of that, right? You guys are saying we have $1 million in our account and we will lend at whatever rate we see fit to that borrower. We're not affected by the Bank of Canada rates. Is that correct?
Correct. Yep.
Theoretically. I would say it's theoretical.
You might change them based on...
Yeah, like if you look at historical private rates, they've always stuck around 10. We're in a very crazy time right now, but most private rates, because interest rates dropping down and keep lowering, we just saw the beeps decrease. We would not, in fact, go back to our fund and say, okay, we're going to decrease what we're lending out at. It's still risk. The banks are allowing.
There's a reason they're coming to you guys for the mortgage in the first place.
Yep. In regards to the overnight rate, it's basically the balancing out at the end of every night where these banks, TD has too much on deposit. What they do is they lend it over to CIBC, who has a difference. It's a beautiful oligopoly system where the Bank of Canada wants market share for all 6 major banks being the same. Yeah. So that rate is more expensive as money becomes more expensive and inflation starts going up. They have to calm down inflation with this back and forth. I mean, the overnight rate used to be 0.25
for like 3 years.
Yeah, for like 5
Not just for
years
a little bit.
I don't even remember.
Great policy.
Heydays. But no, you would not see a direct impact. And I don't know, Tyler, like, are we thinking of offering variable rates, for instance?
That was my next question. Are we doing fixed rate loans, variable?
So right now everything's going to be fixed.
Yeah.
And that makes sense to me because if you're not affected by Bank of Canada policy, then it would make, and most borrowers after the 5-year roller coaster we just went through, I would imagine are going to enjoy the security of the fixed rate, plus the fact that variable rates are more expensive than fixed right now, which gets rid of the whole sexiness of them in the first place, right?
Yeah. Right. Yeah. So MICs are allowed to borrow credit. They are allowed to get operating lines, but you have to be a very large MIC in order to do that with a long, long track record. So there are some MICs where they will say the floor rate's 10%, but if prime rates go up like crazy, then we increase based on once it hits a certain trigger rate.
Now, I would imagine that makes you guys fairly stable because you're not borrowing. You're only lending money you actually have.
Yes. Yep.
And always taking title. We're not ever talking about...
promissory notes.
Yes. Okay.
Promissory notes, what is that?
Never even heard of it.
Yeah.
Something that probably shouldn't exist.
Like an IOU on a piece of paper.
Yes. Yeah. But no, first or second positions on real estate, real property.
And always registered on title.
Always on title. Yep.
Okay.
Yeah. So like, and just to continue, like we had a seminar last night. The biggest thing to realize is the time frame that we're in right now currently. And we're having a podcast today and we're all talking about this. These began in the 70s. MICs actually began in the 70s with the Income Tax Act allowing it to happen. They happened out west. That's where they all began. But what it was doing is it's the government's idea of saying we need to fill the gap. Now, why are we hearing about it now in 2024? Or why are we doing this podcast now?
Because people really
there's a massive gap. There's a huge gap in our system because the government, major changes came in 2009 after the mortgage crash in the States. Then you look at 2016 with the B20 rules. A lot of financial firms went under because they had to utilize and keep 20% of their assets and money on hand back in their accounts. Yep. They couldn't do that. They were utilizing 99% of their funds. So a lot of these government changes has now created this massive gap for lending. And if I could simplify it all down for you, I did this last night. We have a 60-year-old lady. She needs $30,000 against her house that's gone up to $500,000. She owes no mortgage. She needs $30,000. She has no income yet. She's getting her CPP in a year from now. But right now she's just borrowing from her daughter who loves her. This lady cannot get $30,000 from a bank at 30. So what would that be? Maybe 15% loan to value. They will not lend that money to her. They just won't. So what's the solution?
That'd be 6% loan to value, right? 30,000
Sorry,
against.
I didn't want to do the quick math, but it was somewhere around less than 15%.
Realtors are really good at calculating percentages
yeah,
of
man.
house sale values.
But yeah, it's true. Eh? You're like straight up right there. But no, she can't go anywhere. She'll probably go to every bank. They'll decline her. And the simple reason why is there's no more compassionate lending. There's no more sitting down with this lady going, oh, you know what? We're at 6% loan to value. We know your daughter's giving you money and you're going to have CPP in 12 months. What they're looking at is hard facts of today.
And really all they care about is debt to
debt to
service
income
covering ratios, right?
Yeah, your GDST.
So if I have no income, I cannot get loaned any money. Even if I have $1 million paid for house, I can't get any money from a Schedule I bank.
Correct.
Because I have no income to justify the repayment of that loan.
Correct. And that is what we're in today, guys. That's literally why it was a great idea. I love administration, but it was a great idea that Tyler and Sean in our office too found out about a MIC, created this MIC, and it's filling the gap for what's needed. And it's also making it, again, like I always say, more professional. It's a fund that you're borrowing from. We control that fund. You don't have to deal with a private lender in this case. So you're getting money from an actual investment corporation.
Okay. So my knowledge of a MIC, that's it. I'm at the end of it right now. There's a lot more I would imagine you guys have to dig into it here, but my knowledge is done. So I don't know which questions to ask you guys moving on from. So I'll let you take over from here. You guys can ask each other the questions, set each other up for some T-balls, but I don't know anything else about them.
Hey, Duncan, where do we lend money typically for a MIC?
Where do we lend it in?
Where would we lend our MICs money?
Well, MICs, in my opinion, have been lending all over Ontario, but our specific MIC would like to stay in Southern Ontario. And the reason why is because when we underwrite our deals, we know this area. So it comes to investor risk, capital preservation. We want to make sure that we're lending on something that we know the value of.
And your investors would probably respect and appreciate that too, because now they can put their money towards a MIC that's generally lending in an area they're familiar with.
Right. And to touch on that too, if we get a deal that's out in Toronto, we don't know that market that well. We can't call a realtor we work with and say, is this value out to lunch? Does this make any sense at all? Yeah. We don't have the contacts there. We don't have the comfortability there to lend our money and the investor's money somewhere where we're not knowing the values.
Yeah. So maybe you could refer it to another one. But like I even know dealing with some banks, like depending on what the postal code is of the address that you want the loan against, if it ends in an O, they call that rural. And then all of a sudden there's a lot of small towns in Southern Ontario, right? And they're considered rural, but they're 10 minutes from Windsor or
they would even
Leamington.
Some of our MICs and even B lenders would consider Leamington a small community. That's what's crazy to me.
Which has a hospital and transit.
Don't even, And I was just in that hospital about 3 weeks ago and it was awesome. Got my shin sorted out, which was awesome. Like it was great. But yeah, they would consider Southern Ontario. And I would say, in my lending career, Ontario always stopped at London. I'm not even for prime lenders back in the day. It was like anything past London. I don't know if it's the long drive in the 401 where people just forget where they're at, but London to Windsor is this, a long, boring stretch, dead zone. You can't even use your cell phone. But it always ended there where lenders would go to London and it was like, oh, yeah, you're in Windsor? Oh, we go to London, but we don't go that far
That's
south.
Crazy.
And it's like, that's my whole career. So coming into the MIC situation, we knew about MICs existing for the last how many years? And they grew huge. Some of these MICs have gone 400 million under asset management, billions too.
But almost all Bay Street or Ottawa, probably.
Correct.
Yep,
and
BC.
So if and right now you see it where we send a loan to a MIC, and if the MIC's usually up in Toronto, they'll come back down 14-15%.
Where's Wheatley? Where's St. Joco?
Yeah.
Where's McGregor?
I Googled Wheatley and it said it explodes. We can't lend there.
That's literally, you hear about the one ticker, right? The one thing they know about it. And then Windsor obviously been known as the armpit of Ontario. That's what they've called it forever and a day. The coolest thing is though, I went, and this is just a quick side note, we went to New Brunswick, me and my wife, and we went to Moncton. Moncton was known as the armpit of New Brunswick, and now it's the biggest populous area and has the most businesses in it. It's like a resort area too. So I think Windsor's going to change that. Right?
Well, 3 multi-billion-dollar investments in Windsor in the last couple of years. You got the mega hospital, the Gordie Howe Bridge, and then the battery plant, right?
You literally are writing my notes to the lender right now. What do you mean you're declining? We have a bridge.
Your next presentation, you can just play the Everything Real Estate
There we
Show
go.
podcast on the screen.
Yeah, we just put it in the background and you watch it. We just sit and just comment on it.
This was a good point.
So, okay, I guess knowledge-wise, regulations, Tyler. We should go into regulations. Like,
Yeah.
who are we regulated by? There's 2 separate regulators in this whole arena that we're talking about under administration, FSRA.
Yeah. So the MIC is very heavily regulated. It's not like you're just sending money to a random company. We're regulated by the OSC and FSRA.
Ontario Securities Commission.
Yep.
FSRA is the Financial Services Regulation Act.
Yep.
Financial Services Regulatory Authority of Ontario.
Okay.
Yeah. The
I was totally guessing.
No, it was
but I
good.
got-
That was actually.
was running
I would
with
have actually technically should have just said like yes.
Yes.
That's right, Cody.
yeah, double down.
Double
Yeah,
down.
That was great. And technically the Income Tax Act. So because of the way that a MIC is structured, we have to follow certain rules in order to qualify as a MIC. If we don't follow those rules, then RSPs don't qualify as a qualified investment. So we have all these authorities that are watching us, making sure that everything's up to date. We have audited financials for both the MIC and the administration company, which work hand in hand.
Yep.
So there's no messing around. And all the investors get copies of the audited financials at the end of the year as well.
And I would imagine upon dividend distribution and things like that too, there's probably quarterlies that go out. And
Yep. So we get monthly statements. We give them to everybody as well. Any filing we do, anytime we take money in, we have to file it with CEDAR, which is a division of the OSC. So every step of the way, there's someone watching.
It's a lot of paperwork. It is. It's a lot of administration work. But the thing is, I was just tired of 13, 14, 15, 16% from Northern Mix. Like I wanted to do something local. We all wanted to do it local because it was just something that fills this gap and it allows other people. And if you want to get into it, this area, in my opinion, in my whole career, I've just noticed it in the financial sector. It's stripped. It's constantly stripped. All our union heads, all the, let's say, organization heads, everything's out of Toronto. Everything's up north. Everything's out of London.
Yep.
What stays down here? Even, for instance, I've noticed in the banking industry, CIBC used to have the big building downtown Windsor. It now operates, I think, 1 floor out of that building because everything gets shipped to Toronto. It all gets centralized.
they don't even own the building anymore. It's called the CIBC building.
Yeah, they don't even own it. So in essence, the last 20 years, financially, in my opinion, Windsor has been stripped of its money earning ability. And I want to bring that back. So in a bigger scale of things, if we create a MIC down here that services, we can at least churn the money in Windsor. And when I say churn the money, it means provide the borrower that lives down the street. We can provide him money from a borrower that lives locally in this area, and they both make out better. You know what I mean?
Yep.
The lender makes his return, goes and spends that return on
Maybe at the borrower's business.
There we go. I like that. That's perfect. Actually, that's kind of where I was going with that, but I like it. It does. He did.
You
He
keep
walks
it in
in.
this community.
Keep
though.
it in the community.
Keeps
is what I
everything
want.
local. And something that we should touch on too is when people hear that we're lending money privately and they hear the rates that people are paying, they get scared and they say, well, what kind of people are you lending to? Are these people that are not going to make their payments? What's the story here? Something big that we focus on is there has to be a story for why a deal makes sense if we're going to put it in the MIC.
So we're getting back to old school banking here. So I had my dad on the podcast a couple episodes ago, and he was talking about how when he ran his bar, he had a mortgage with CIBC, and the bank manager would come over and meet with him.
Oh, yeah.
Once every couple months, and he'd want to hear their story and see how they're doing. Now it's like, no, you can't get someone on the phone. Are you kidding me? You send an email. It goes through 3 floors of work from home condos in Toronto, and you're lucky to get a response in 2 weeks.
Yeah.
So now you're saying, no, we actually...
Yeah, like the human touch was there. It
Yeah.
was back in the day.
Yeah. So that's the big thing we focus on is what's the story? Don't get us wrong. We do have a lot of deals that are submitted to us. We've had, I think we're nearing 300 files that we've underwritten and looked at. We closed 50. So we see a lot. There is a lot of people that just don't make their payments. So
the story is great,
borrowers.
but we still want credit score. We still want to verify income.
And even if the credit's not good, what's the story behind it? Was there an accident at work? Was there a death in the family? Is there something that makes sense where we'll put this Band-Aid on, we'll do a small second mortgage, clean up credit cards, fix credit, put it in for a 1-year term, open after 6 months, and then 6 months from then you refinance out with a regular lender, or if it's not quite there, B lender, do another 1-year term, and then go back to WFCU or credit union after that.
And so if someone was, okay, guys, this sounds great as far as returns. I don't want to be a loan shark. I don't want to be, crippling granny just because she needs to get by until she can get her government subsidy, whatever. You're going, no, we're trying to meet a need now. The goal is to get them
Band-Aid
to a B or an A lender. We don't want to keep them in a high interest rate environment for a while. We want this to be a success story, not a continued oppression.
Right, exactly. We definitely don't want that. It's got to be a Band-Aid that we deal with the situation and then get them back to regular financing.
So I can feel good about making money too.
Exactly.
Correct. And I would say that goes back to like the window concept. Like the borrowers in front of us at this time, it's a window opportunity to say, okay, we can Band-Aid that situation. This is going to be a 1-year plan. I don't think, and on our office specifically, we'd never put someone in not knowing how can they get out. Is there a reasonability? Because no offense, what's the point in them the borrower paying all these fees, going through all that when we know I'm calling Cody to list a house to sell?
So when in the office when they have a surplus and Oscar tells Michael that he has to spend the money or else he won't
I love this
have the money in the I think you guys need to create like a picture book that explains what a MIC is and why I would get a mortgage from a MIC and explain that, well, Joe, he lost his job, but his mortgage was coming up for renewal and he couldn't quite qualify.
Yeah.
So he had to go see Tyler and Duncan at Erie Shores Capital to secure a 1-year term so that he could build his credit and his lendability back up. And then he threw a big mortgage burning party after 5 years when he paid it all off and everybody lived happily ever after.
We'll use creatures as the characters instead.
That would work.
Little rabbit goes down to the badger. Something like that. But no, it is, if you think about all of it, it's a lot to think about. I would say just simply put, if I say if a borrower is having troubles getting approved, let's look at the MIC before they go into any kind of individual private situation or end up getting a loan out of Toronto or anywhere north. Let's keep it local. And then for investors, keep your investments local too.
Even worse is the amount of Fairstone loans we've paid out that are at 30%.
What's a Fairstone?
So Fairstone, or what's the other one?
Doesn't sound fair.
It doesn't,
oh my gosh.
I can't remember. It's blanking on me. But a lot of people know the name Fairstone. Easy Financial.
Easy Financial.
Oh, so these are like money mart loans, basically.
Because they'll advertise,
but on steroids.
Like, here's your TV. You'll be paying for it for 9 years.
A lot of people will see that and they market that if you get a loan with us, we'll wrap in all your debt, consolidate it, you have a low payment. But their APR is 20%, 30%. I've seen 30% kind of frequently.
They pay with the creditors, but then wrap a huge interest rate around the whole
We
consolidation.
can even go to payday loans, man. We know guys, I would say borrowers don't always, and we're in the market all the time. We see social media, we see all the things happening, and our jobs are to do that. There is people out there that have a free and clear home and are borrowing from payday and not realizing that we could probably provide them a no payment mortgage or something like that.
Reverse mortgage.
A reverse mortgage, things like that, where they could get sorted out instead of taking like payday loans or I don't even know. I think they just changed the act on that too for what you can charge because at some points they were 40%.
Yikes.
40, 50%. And they're trying to bring down the criminal rate of return. What is it?
It was, I think it's 60 still, but they're bringing it down to 30, I believe.
Yeah, 30, 35.
I think it's 30.
So there's just a lot of checks that are happening in the market now because I think a lot of people take it too far and go too far. I would say, in essence, our job is to look at
lending.
Yeah. And you'd think it wouldn't happen in Canada, right? Like you'd be like, oh, that sounds like a States kind of thing, right? Like predatory lending, but it did creep up here. And I think we're trying to, battle it every day. Every day we lend out money. We want to make sure that these borrowers are taken care of, fill the gap, fill the need, but get them out as well. Like what is the end result? And like I always said, if they're not going to be able to get out, why don't we think of non-home ownership or why don't we think of downsizing or why don't we think of renting instead?
Or renting for a period of time
Yeah,
until we get
yeah.
back to.
Yep.
Okay.
My mom always said, take 2 steps back, take a step forward sometimes. That's what you got to do.
Yep. So I'm looking at our notes here. 2 questions that I'm seeing we haven't addressed yet is MIC versus stock market.
Ooh.
So what would be the advantages of investing in a MIC over a stock market? I'm guessing that's what we're getting at with that.
No, not the advantages, just the difference from going into the stock market. So there is, I mean, I've tried it before, guys. Let's be honest here. It's a lot of research. So when you look at the stock market, most people think, oh, I can go and lend my own money out on mortgages, or I can go in the stock market. To keep track of all the information and not lose, your ship or not lose every bit of your dollars, it takes a lot of skill set. Whereas a MIC, your money's taken care of by professionals that are in it, that have been doing mortgages forever. So what's qualifying, what's going into that is you have a team backing up what's actually qualified to go into the MIC, meaning your return's coming from expertise.
Well, and if I'm a personal investor in the stock market, which I'm probably investing with emotion, which I've been guilty of.
Oh, yeah.
You read a few news articles, you hear about what's going on overseas as far as like wars in different countries.
Yep.
You might all of a sudden pull back some money, but if I know my money is simply invested in mortgages in this specific area right here, I'm not susceptible to my emotional decisions versus the technical trading, which is what the huge funds on Wall Street, they're making their money off of technical, not off of emotional.
Correct.
But I can probably pull some of the emotion out of my self-directed investments by investing locally and in mortgages rather than investing in, one real volatile industry in Canada over the last 5-10 years has been marijuana, right?
Oh.
So heavily affected by, it was illegal, now it's legal. It's the hot thing. Now no one wants it. Are the companies being run? So you read a couple news articles, you
Are
pull
they
all your money
actually
out.
going to earn that much return based on this many people smoking marijuana? We don't know. The whole medical side of it. I was also a victim of the beautiful marijuana stuff.
So that's just one example, right?
No, it's a good example. So then we look at the stock market. What's better than the stock market? Well, financial advisor and advisors and stocks. They put them together in a fund.
They take the emotion out of it.
They took the emotion out of it and they made it a mutual fund. So this mutual fund is layered with so many different, stocks and stock names. And what it's going to do is decrease the risk to the investor and take the emotion out. Mm-hmm. So now you have to look at, instead of a MIC compared to stocks, let's look at a MIC compared to asset-backed securities. And that's essentially what we are. We're an asset-backed security.
So like the US dollar used to be backed by gold, which is what made it the strong house
Correct.
that it was. We have an investment that's tied to title on property.
Real estate.
Collateral.
Yep.
Yeah.
Yep.
So when you look at the difference too, and I've looked at many investment statements thus far, and I could say some advisors, they're really, really good at what they do. Okay. But there is other advisors that put your money in a fund and let it ride. They don't really do anything because
it's not actively managed.
It's not actively managed. But
if you're high net
collecting
worth and you got the right person, I'm sure it will
Oh
be.
yeah,
Yep, absolutely.
But then the person that put maybe $60,000 into just the Fidelity or some kind of name fund, who knows what it's called? Do they know what they're actually in?
Yep.
What I love and the comfort I have, and obviously we have invested in the MIC as well. What I like is I know what I'm in. I'm in mortgages, which I deal with all the time, and I can control the exit from it.
Yep.
How do you control the exit from one stock that's layered into a mutual fund that's within another fund within another fund? How do you control that? There is no control. You're hoping.
And I would imagine you're paying for a fair amount of bureaucracy and administration at that point too, right?
Yep.
Yeah.
So
So
that's a lot of people's gripe with mutual funds is how much fees are you paying on your funds going in? Yeah, there's a great return history, but what are the fees associated with
I've
it?
seen some range from some of them are getting 14%. I've seen it. It's really nice. I've seen other people with smaller amounts making 4%. I mean, you might as well put your money in a GIC at that point, right?
At least it's guaranteed.
Yeah, and if you look at the risk that the fund they're in, it's maybe U.S. equity. Maybe it's an equity fund. That's a risky fund compared to an asset-backed security that has collateral, like we talked about, where it's backed by borrowers paying mortgages.
Yeah. Okay. We're running pretty good time on the show here. And I would imagine that the entire audience has found the entire concept of mortgage administration and mortgage investment companies absolutely illuminating. I guess, a couple minutes to each of you guys here. Is there anything that you want to leave the viewers with? And obviously they can contact you for further info. And one further disclaimer, we are not giving investment advice on this show here. However, contact your professional, and you're certainly welcome to contact these gentlemen to find out more too.
Yeah.
But anyways, I'll turn it over to you guys to close it out if there's any final thoughts.
Yeah, I think just to put in summary of what a MIC is, it's once you bake it down to its bare bones, we're lending money against property to people that need it. This is a window that has opened up in the past few years with government regulations. Regular banks aren't able to do it, so we're going to have to do it for them for a Band-Aid solution. And then it's secured to property. It's as easy as that.
My additive to that would be, I want to grow a fund in Windsor, Ontario, so that people can borrow from Windsor rights and lend it back out to Windsor rights. I wanted to grow this fund so big that people know that they can go to us for proper gap lending, and there is a massive gap, and I would like to fill that gap with people that want to invest and maybe look over your mutual funds and your investment statements and see, is there any amount you would like to actually invest in this, because it's going to help other Southern Ontarians, I guess, not Windsorites, but Southern Ontarians. Like, I do want to help the fund and help other people borrow.
Cool. Ladies and gentlemen, Tyler Tiessen, Duncan Wilson, thanks, gentlemen.
Thanks for having us. A lot, Cody.
Thanks for listening to the show, folks. Please keep in mind that this show is not offering legal, financial, or accounting advice, but rather opinions and experiences in the world of real estate from the host and the guests. If you're enjoying the show, please rate, review, and share with your friends and colleagues. And if you think that there's someone that needs to be on this show, please feel free to connect them with me. Or if there's a topic that should be discussed, feel free to let me know. Thank you so much, and bye for now.